Good afternoon, ladies and gentlemen, doctors. Thank you for joining us. I see a bunch of people have recently joined from being chairside. Thanks again for your time today. And I'm joining our webinar regarding wealth protection and financial planning for the profitable practice. We have a special webinar today for you. My name is Eric Pook. I manage the healthcare leasing team here at Cirrus Consulting Group. And I'm joined by two special speakers, Joshua Mosko, Vice President of Client Wealth Management, and the David Rosenberg, Chief Economist and Strategist at Gluskin Sheff Associates. I myself have had a personal relationship with Gluskin for the past 7 years and have been an avid subscriber of David's market commentaries and morning commentaries over the years. And we're certainly in for some great discussion on the markets today, as well as how to get a better understanding of how to protect the value of your practice through the dental office lease, and also why now is the best time to be planning for your eventual transition and retirement. So a little bit about Cirrus. For those of you that haven't worked with us in the past, we are a unique firm that is healthcare and dental specialized for tenant representation, representing doctors, dentists, and veterinarians in the dental office lease negotiations. We were originally founded by dentists for dentists from back in 1994, so almost 25 years. And in that time, we have successfully negotiated over 10,000 dental and medical office leases. What makes Cirrus unique is our structure, which is really 3 into 1. So we have our own in-house legal commercial real estate attorneys specifically experienced in representing doctors in their lease negotiations and doing all the negotiations from start to finish to ensure that there's dental-specific language and that the dental practice is protected. We also have a leasing team consisting of former brokers and others, as well as proprietary information, so we can know and have a great understanding of the local market rates, local vacancies, as well as all the specific information in your buildings from a commercial real estate perspective. And last, the consulting departments, which I manage, which is the team that's involved on the onset to help have some of the business level discussions about your practice, including in determining where you're at today with your practice, as well as the eventual goals, to ensure that we're starting to create a specific real estate strategy that aligns with the business goals of your organizations. Annually, we represent about 1,000 plus doctors throughout North America, and we deliver these, such as the one today, about 100 plus continuing education accredited seminars annually, and we are PACE accredited. And of course, lecture at many of the major dental conferences, including the Hinman that's coming up, and many of the other conferences you may have seen us in the past, and the CDA, which is coming up in a few weeks as well. So there are 4 main stages in your career of which we can be of great assistance. First, the doctors starting the practice or looking to establish or acquiring an established practice today. We would be involved with helping to locate a new property for you, as well as negotiating the original letter of intent or offer to lease, ensure it is non-binding, to ensure that the full and final lease is negotiated to your satisfaction and is designed to protect, limit your liability, protect your future business, and ultimately really provide a solid foundation and concrete footing of which to build your future business upon. As we'll see today, the dental office lease has many impacts to the business to ensure that it's properly staged to ensure at maximum value and becoming an asset versus a liability to the firm. In addition, if you are a currently practicing dentist, they're looking to or have a lease that is due to renew in the next 2 years, is a perfect time to renegotiate the lease well in advance of that expiry, specifically so that you're protected. In addition, if you're also looking to retire in the future, which I know many of you on the webinar are today, if you're looking to sell or transition, it is most important, usually 5 to 10 years prior to that eventual retirement, to properly rewrite and adjust your lease to ensure that it is able to be sold and sold at a maximum value. In addition to that, we have office expansions or remodeling, or if you are relocating, is a perfect opportunity to dust off that lease out of your office drawer and make sure that it is rewritten and adjusted to be much more specific and aligned to be your specific language, not just 100% of the landlord's. So a few interesting facts. Over 75% of doctors today have office leases that can prevent them from selling their practice. And we'll touch on a specific example today. In addition to that, doctors typically are signing it personally or are becoming a personal guarantor, including their spouses or in some cases their family, depending on what was negotiated upon originally signing the lease when you started your practice. Also, most doctors we deal with don't know how valuable they are to the landlords. The landlords are skilled business owners and skilled negotiators on making it seem like there is a lineup of other tenants to take over your space tomorrow and that you must pay and sign all the terms without any negotiations. That could not be further from the truth. You represent some of the best commercial tenants out there. Why? Well, number one, you have incredibly low default rates. Ask yourself if you have paid your rent on time, if you have been a good tenant, if you're even fixing some of the specific landlord challenges yourself just to not be a bother. You represent being an excellent tenant. You also represent the largest and most investment-heavy group to invest in to start up a new business. So in commercial real estate, in many cases, you're spending $100, $150, in some major markets up to $200 per square foot to build out a new commercial space. Therefore, every dollar that goes into the custom electrical, custom plumbing, right, in some cases even cabinetries or fixtures into the space instantly becomes ownership of the landlord. You also bring in a lot of profitable as well as high-quality foot traffic. Right, they come back again and again, year over year. In addition to that, you're also increasing the building value due to the long-term tenancy. Most tend to spend 20, 25, upwards of 30 years in the same location. So really, the purpose of today's webinar is a fewfold. Number one, wealth protection. Right? It's obviously top of mind for many of you on the webinar today, right? And how to identify some of the top $100,000 traps in your dental office lease. Also, some of the key dangers of signing your office lease in your personal name versus the shell or professional corporation. In addition to how to prevent your landlord from interfering with the practice sale and removing their right to collect sale proceeds that we're seeing more and more throughout North America. And last but not least, and most importantly, is truly how to structure your lease to reduce your own personal exposure, as well as to prevent your family and estate from absorbing the unforeseen debt in the event of your inability to work or having a dental-specific disability. And this is something, again, we're seeing more and more of. Doctors would get calls at the 11th hour after something happens. The doctor is looking to be able to step back or walk away from the lease based on an injury or passing, and this can become a major issue where because of the lease, you're contractually committed or your estate is contractually committed for each and every monthly payment over the remaining 5, 10, 15 years of that term. Major liability that can definitely be negotiated and absorbed to make sure it's more flexible and to your benefit. So ultimately, what is a lease? We lecture throughout the country specifically and ask this question, and every time we get different results. So if you were to ask yourself in a word or two, what represents the lease? Commitment, right? But ultimately it boils down to representing to one core thing, which is a paycheck. And this is typically the only element that most doctors will negotiate, the first half page of their 60-plus page agreement, based on who is responsible for paying that check, yourself personally or your company, and specifically what that amount is, how much that increases per year, and when that is required to be in the landlord's bank account each and every month. If you were to look at it from a different perspective, if you're about to sign on to a new lease for a new practice, and you are spending on average nationally about $3,500 per month, if you look at that over an annual basis of about $42,000, That, over the average tenure of an average practicing general dentist today, runs about 30 years. That represents over $1.2 million in expense. Therefore, if you knew you were signing a $1.2 million check, would you make sure you had legal representation or an expert specifically review your lease in advance? And most, unfortunately, do not. And therefore, it's a lot more time and energy in order to correct some of those mistakes now that you're into those individual spaces. So why? Why is it so important? First of all, specific to your dental practice, your business is location dependent. Your location is your business is your location. An example of that is if you were to receive a registered letter tomorrow saying that you are required to move to a different property that the landlord owns, or from Suite 1A to Suite 3C, and you were given 30 days notice to do that relocation per the relocation clause in your lease, what impact would that have to your business? What would the costs be? How long would it take you to physically relocate, build out, and beyond? In many cases, that is upwards of 6 to 12, in some cases in higher markets with permits or otherwise, up to 18 months. So how many months would you be dark? What would your patient attrition be as a specific result? So your location is critically important. And your lease defines your right to be in that location or the ability for the landlord to move you. In addition to that, the cost, right? As we mentioned before, hundreds of thousands of dollars goes into building out that new space, custom plumbing, electrical, the designs, all the specific involvement in terms of creating that practice. And they know that. Landlords know this, so they use this to their advantage to make sure that they know how time-consuming it is for you to move, and they will use that as negotiating leverage to make sure that they minimize the time, knowing that it can take up to 6 to 12 to 18 months for you to build out a new practice. And also, we'll touch on today why it is so critical for the practice sale. So let's say, hypothetically, you would design your own lease. So the lease you've signed today is 100% specific to the language that the landlord has required. What if you were to write it for yourself? How would you write it, and what would you be doing to protect yourself? Well, I would imagine that you would, first and foremost, make sure it's designed that if one of your largest retirement strategies is based upon the eventual sale of your business, you would want to make sure that you are able to sell that business and make sure that you're creating it to be a asset versus a liability. In addition, I'm sure you would want to make sure that you have fair and affordable financial terms, not only initially, but also protecting from high annual increases or landlord-specific language that they can completely readjust to, quote, fair market rates or by any arbitrary amount at the point of your lease renewal. Also, I'm sure, based on the needs of the bank or lending institutions looking for long-term stability and security and continuity for your space as you're looking to get a return on that investment and build out your practice, and also minimizing your risk and exposure. Why, after being in your practice for 5, 10, 15, 20 years, still be personally liable once you've now proven that yourself or your business entity is responsible for paying, you've an established business, and should no longer have to personally guarantee your risk. And also maximizing your flexibility, that heaven forbid something happened to you or your ability to practice wet finger dentistry to make sure that you have the ability to walk away from that lease through any sort of death and disability protections. So let's talk about the value of the practice. So if you ask yourself, what are the 3 main sellable components of your practice? What are you selling and what value are you going to receive from selling your practice? And typically, we see that being anywhere from 60, 70, 80, or in some major markets, 110% of your annual collections, right? But it also boils down to 3 core fundamentals. Number 1 is your equipment. What is your new advised amount, right? Amortized amount of your specific equipment after it's been depreciated? What is the current market value of the equipment? And all your hand tools and everything, including inventory, in your practice today that you're selling. Right? That's the easiest one. The next is your goodwill. What is the predictable income and the likelihood that your patients are going to return? And what is the revenue stream that the new dentist is acquiring to make sure that they can protect and build their business off and recoup, right, their $1 million investment into purchasing your practice? Right? But the last and most important perspective is the lease. right? The lease and therefore the location. And that can impact up to 100% of your ability to sell the lease. 100% of your ability to sell the practice is linked to the lease. Did you know that most dental tenants, such as yourselves, have signed a lease agreement that has overly restrictive terms that may prevent you from selling your specific practice? And unfortunately, most dentists only learn this the hard way after the landlord has creatively leveraged some of these clauses to recoup or make their bottom lines look better, or in addition, right, that they're actually using it now to jeopardize the sale, or at the 11th hour, the lease is required as a component or condition of sale to be sure that it is transferred from the assignor, yourself, to the assignee, and your landlord must give specific consent and written consent to do so. So here's how. How is the landlord able to hold this over our heads? How are they able to have such control over the eventual sale of your practice? Well, this particular section governs your ability through the assignment section, defines your ability to transfer or sell your practice, and assign your lease obligations from one to the other. So, if you take a quick moment to scan the attached, see if you can identify 3 or 4 or 5 major components that will directly impact your ability and your retirement, as well as the value of your practice. So take a few seconds now to have a quick view. In the first paragraph, you may have noticed this. First and foremost, it shall first have received the consent of the landlord. So even before you're able to enter into the negotiations or sell the practice, the landlord must give you written consent. Therefore, they are in 100% control of the eventual sale of your practice. And if you haven't carefully defined the extent of that exposure or limited how they can approve or disprove some of your incoming doctors, right, that can dramatically impact who can hire your practice and who can acquire your practice. The next main section is pretty interesting. The landlord shall have the option to, 1, approve your tenant, give you the green light. Number 2, decline the tenant's request to assign the lease, right, give you the red light. Or number 3, to terminate your current lease agreement upon the effective date of such proposed lease assignment or subletting. So just for asking, this language gives 100% control to the landlord to terminate your current lease just purely for asking to sell your practice and having it assigned to someone else. Right? And this type of language is in 75% of dental leases we review annually. In addition to that, it gets worse. The landlord shall have the right to revise the minimum rent to be paid during the remainder of the term to the greater of the then current market price for the lease premises, or 15% greater of the then current rent. So therefore, upon the successful sale of your practice, this then impacts your ability, and at the 11th hour, the landlord can say, yes, I approve, right, Dr. Smith, to purchase your practice. However, we want to add a condition, and we want to raise the rent by 5, 10, 15+%, which is fully allowed based on this terminology in your lease. So unfortunately, it is all down to the contract law, and what is devised in your lease is what governs and what controls the eventual sale of your practice. Also, this is quite interesting as well, that should the tenant receive from the assignee or subtenant any rental income, cash, goods, or any form of consideration in connection with the assignment of this lease, meaning the sale of this lease, right, that is over and above the current base rental rates payable to the landlord in any fiscal year during the term of this lease, the difference between that annual rent that you would pay and such rental income, cash, or other consideration shall be paid to the landlord directly within 30 days of tenant's receipt thereof. In essence, doctors, this means that if you were to sell your practice, for every dollar above what you would be paying in annual rent, right, that you have over the last 5, 10, 15, 20, 30 years to build up your business, the landlord is entitled to every penny above that dollar of rent that you would have been paying. This is, right, what might seem as unbelievable. This happens more than you think and all the time, based on the specific language in here. So they can make it much more difficult, and they can make the actual sale price and the sale proceeds, right, deemed based on the lease that you signed, right, something that they are entitled to. And last but not least, of course, right, based on that assignment, you will be continually liable, remain liable for any failure of the tenant or assignees or subtenants to observe each and every covenant of the lease. This essentially means if you've retired and are living the life down in Florida, you are still, in essence, co-signing or continually liable for that new doctor that you sold your practice to. And if that doctor doesn't pay their rent or in violation of the lease, you are still continually liable. And if you've signed it personally or a personal guarantor, that means you are now personally liable for that eventual sale of the practice. So, did you know most commercial tenants, dentists included, have included to provide the landlord with unconditional personal guarantees, exposing your family and estate to unnecessary risk? In the essence of time, these are just a small cross-section of many of the clauses in your leases today that need to be dental specific and revised to ensure that your amount that you are saving for retirement or the amount that you're going to receive from selling your profitable practice down the line is protected, and that your lease becomes an asset versus liability. And our team of in-house legal attorneys are specifically experienced in crafting language that is accepted from the largest institutional investors to the small mom-and-pop shops. A few points just to finish off before transferring to the team is the tenant lease cycle. So this is actually an excerpt of what the landlords get trained on to maximize the value of their business and cap rates. And this is what they don't want to tell you. Number one is you have a 24-month cycle, and this describes the amount of leverage you have in your upcoming lease negotiations. The ideal time is 24 months. Is the ideal time to start your negotiations. Why? Because it takes upwards of, again, 6 months to a year to 18 months to build out a new practice. And therefore, you want to have the time and flexibility if you're unable to come with any sort of fair terms, or if the landlord doesn't want to renew, or your options have expired or are null and void, right? You want the most time to maximize your leverage. If in that case, you are also, right, in terms of the landlords, they know at 12 months they will use every stall tactic possible to delay your negotiation, right, in order to start closer and closer to the time where you have no choice and you are forced to re-sign whatever terms the landlord will put in front of you. Most unfortunately will wait until after your option to renew date has expired, which in your lease defines when you must notify them if you want to extend or renew any of your renewal terms. If you do not send that in writing, usually 9 months towards the end of your lease, all those 5-year renewal options or 3-year renewal options will become null and void, and you will have no legal right to be in your space beyond that point. So leverage time. Start your negotiations 24 months in advance to maximize your leverage. So some of the secret sauce, just to finish, is ultimately making sure, first and foremost, our process that we've refined over the past 25 years for success is, number one, gathering all the information. So we want to, in order to provide a lease review, we want to have all the information. Your original lease or the original governing lease from the previous doctor if you had purchased it from someone else, gathering all the information. In addition to that, we then want to get all the addendums, riders, etc., and then we want to have a call with you to understand your current practice goals, objectives, and where you really want to grow the business to, and ultimately when you plan on retiring. We also want to then review your current lease and give you some of the examples like we went through today on how your lease has very similar language and expose you and share with you some of the exposures you have with your lease today, as well as looking at the commercial real estate, compare some of the market research and some of the millions of properties we have access to in terms of looking at comparable market rates, so we have a solid understanding for where we can negotiate the financials of your lease. And then Section 5, overcoming and creating an outcome and strategy for ultimate negotiation success. ending with lease negotiation economics, negotiating all the terms of the lease. So we will negotiate all the financials first. Once we've successfully negotiated the fundamentals, we'll then negotiate the specific legal terms and end with the final review and execution of the lease, which you will then approve, sign, and put this in a nice desk drawer and know now you have a warm blanket of protection versus unknown risks and liabilities. So, for all attendees on this webinar, in appreciation for your time, for not being chairside, and receiving some additional benefits, we have our CDRA, which is a critical dates and risk analysis. This involves approximately 3 to 4 hours analyzing your lease as well as traps in your lease. In addition to that, through the 1-hour scheduled call, we'll get the information we just reviewed. We'll get a good understanding for your vision and plans, some of the traps specific in your lease today, what your ideal lease should look like, and most importantly, how we can effectively negotiate that for you. As a value for that, we're able to offer this as a complimentary service for attending this webinar. We do have a limited number of these available, so please contact myself or anyone on the team. And as you can see in front of you, you have the option to request a complimentary lease consultation. I would suggest either putting in a yes or following up with us directly in order to schedule an individual lease review. If you did, as a note, just put in your first name, please ensure that you've followed up with your additional contact information. I see most of you put in a first name and last name, but if it's just a first name, please ensure that we have your current contact details. Thank you very much again. Looking forward to working closely with each of you as you look to retiring, as you look to move towards transitions. We look forward to making sure that we can share and help. Excellent. On that note, it is my pleasure to introduce our next speaker. Josh Mosko is our VP and Client of Wealth Management Strategies at Gluskin Sheff Associates, a fantastic firm designed to help high net worth individuals and successful individuals make sure that they have an adequate retirement strategy and solutions for their ongoing wealth management needs. Josh, over to you.
Thank you very much, Eric. It's a pleasure to be here today. Get going here. So as I said, my name is Josh Mosko. I'm a Vice President with the Client Wealth Management team here, and I am joined by my esteemed colleague, David Rosenberg, our firm's Chief Economist and Strategist. So for those of you that don't know much about Gluskin Sheff or know us at all, we are an independent wealth management firm with over $9 billion in assets under management with private clients across North America. Now you might think that all investment management firms are the same, offering the same products and the same services, and to be honest, it's reasonable because a lot of those big firms are, especially in North America, where the big banks and the brokerage firms are really trying to be everything to everyone using very much a cookie-cutter approach. But I can assure you that we are not like everyone else. We're big enough to have a strong reputation and influence in the industry, but we're small enough also to be dynamic and innovative and really build long-lasting and personal relationships with our clients. We're not generalists, but we are really specialists in our industry, very much like our co-hosts at Cirrus. There's a few reasons I just wanted to highlight that have helped us be successful over our 34-year history managing money for high net worth private clients. Firstly, almost our entire client base consists of individuals and private families, many of whom are successful professionals and entrepreneurs just like yourselves. And we've really developed our talented team of professionals and our investment philosophy with a real understanding of the unique needs and objectives of our private clients and their families, who have looked to us to ensure that the current and future generations of their families are well looked after. So everything we do is really with our clients' best interest at heart. We have a platform of investment strategies designed to protect and grow our clients' hard-earned wealth, and every decision we make has a focus on risk management, because at the end of the day, we want to help our clients sleep at night. Not only that, our firm's interests are really aligned with our clients. Every Gluskin Sheff employee collectively is the largest shareholder of the firm, and every employee at the firm also invests their own money in the same portfolios as our clients. So we can honestly say that we really do eat our own cooking. We work hard to develop long-term and meaningful relationships with our clients, and we want to help our clients and their families thrive over the long term. For the attendees today, we have many currently practicing and retired doctors as clients, and we really do appreciate the significant demands of running a successful practice while maintaining your clinical expertise in such a complex field. We want to be sure that our clients can focus on what they do best, just as we do for them. And we have experience helping doctors with their financial well-being at all stages of their career, especially the sale of their practice and what it means for them after that. So now that you know a little bit more about the firm, I'd like to introduce David Rosenberg, our Chief Economist and Strategist, and the author of the well-known Breakfast with Dave Daily Research Report. Dave joined Gluskin Sheff in 2009, and prior to that, he was the Chief North American Economist at Merrill Lynch in New York for 7 years. David will hopefully shed some light on the current macroeconomic environment from our lens, and of course the investment themes we're focused on for our clients at this stage, which will hopefully be of benefit to you as you think about your own financial affairs. So over to you, Dave.
Okay, thanks, Josh, and good afternoon, everybody. At least afternoon for those that are on Eastern Daylight Time. In any event, you know, I realize that we are in what I would say a heightened state of uncertainty. You know, whether we're looking at monetary policy, especially as it pertains to the Federal Reserve in the United States, which is the most important central bank in the world. Uncertainty related to fiscal policy, trade issues, NAFTA, the revolving door that we see at the White House, and of course domestic and global geopolitical issues. I guess what we have in our hands, from my perspective, is uncertainty with a capital U, and a market backdrop this year, no matter where you look, that has become more two-way traded, more volatile, and it seems to me as though the markets are giving us a lot of information here, which is that we're entering into a late cycle transition. So even though we have a tremendous clouds of uncertainty, what I want to focus on is what we can nail down with a large degree of certainty in an uncertain world, and how we can simplify things and actually come up with a cogent and coherent and appropriate investment strategy for our clients. So we're talking about late cycle, and if you go back to Herb Stein, who, if you don't know who he was, forgive him, Richard Nixon's chief economist back in the 70s, but actually a brilliant man. His son is Ben Stein. If you remember the famous Bueller in Ferris Bueller's Day Off, he was the teacher. And if you remember that scene, when he goes Bueller, he's actually talking about Smoot Hawley and writing it down on the blackboard. And maybe in this context of heightened global trade tensions right now, beyond just NAFTA, maybe that's rather apropos. But I always thought that the old saying, the refrain, if something cannot go on forever, it will stop, is so obvious. But yet, I think so apropos in today's environment that we are seeing firsthand, just looking at the financial markets, which is really what I do. I take the economic data points and I relate them to the financial markets to come up with investment advice for our clients. And as I said, anything that can't last forever will stop. And the broad-based rally that we saw across all markets last year, whether it was Bitcoin or cryptocurrency in general, the art market, momentum stocks, growth stocks, emerging market stocks, even the bond markets, was a one-way ticket north last year. Things are starting to change, and change in a way that has me convinced that we're heading into the late part of this economic cycle, and we have to be investing appropriately in that environment. So when I take a look at the situation as an economist, what do I see? Well, these bars are the length of economic expansions. I have data all the way back to the Civil War, and you could see that we just this month entered into the 105th month of this economic expansion. A normal expansion, when you go back to the Civil War, that averages about 40 months. The average in the post-World War II experience is more like 60 months. So no matter how you slice or dice it, this is a cycle that is very long in the tooth. It's already the third longest on record. If it goes to May, it'll be the second longest on record. You know, only next to the 1990s expansion, which was a record 120 months. And I remember whether it was the Reagan years of the 80s or it was the internet years of the 90s, people built up in their expectations that the cycle is just going to go on to perpetuity. But we all know that that doesn't happen. Recessions are followed by expansions. Expansions are followed by recessions, just as bull markets are connected to bear markets and vice versa. Recessions, thankfully, are short affairs, sometimes pernicious, like the last one. But expansions tend to be long and strong and get interrupted by recessions, which is just a dynamic, not to run away from, but to understand that they clean out the excesses left over from the previous bull market or expansion, and then you move on. So we should just take note that we're already 105 months into this thing, whether you're in Canada or the States, and it's well above the long-run norm. Now, people will always say to me that expansions don't die of old age, and I understand they don't just die of old age. They usually die at the hands of the Fed, and the Fed is raising interest rates, probably will continue to raise interest rates. And you have to treat a Fed rate hiking cycle differently than you treat a Fed rate reducing cycle. We are in a rate hiking cycle. No matter how gradual the Fed is, interest rates are moving up, they're not moving down. That creates another certain dynamic. And the reality is that cycles do come to an end, and expansions come to an end as much as recessions come to an end. I'll show you later that I'm not talking about the fact that we're in the bottom of the ninth inning, but I think that we're actually closer to the bottom of the eighth inning, and we have to invest appropriately. I always hear how well consumer confidence is doing, and you can see in this chart that consumer confidence is an all-time high. And you'll be thinking, well, how could you be talking about the end of the cycle with consumer confidence at a record high? And you can see in this chart, and the shaded areas are actually periods when we have an economic recession. And what do you know? Consumer confidence tends to peak within a year, traditionally, before the recession starts. And if you're taking a look at when it actually bottoms, it bottoms right when the recession is ending or has already ended. And so that's why sometimes they call this business of economics the dismal science, or maybe sometimes it's just great to be, as an economist, calling the markets to look at the economic data sort of upside down, almost as a contrary indicator. So it's interesting because you would think that at the peak of consumer confidence, things can't get any better. And that's exactly my point. My point is the old story, the old story of the optimist and the pessimist having a cup of coffee, and the optimist goes, things can't possibly get any better. And the pessimist goes, well, I think you're probably right on that one. So that's what we're talking about here. You see, at the peak of the cycle, your belly is full. You've consumed the 5-course meal and you can't stomach the creme brulee. You basically, in the expansion phase, when consumer confidence is at an all-time high, it means you bought every iPhone, you bought every car, every piece of furniture that you could possibly buy in a cycle. Your belly is full. There is no pent-up demand at the peak of consumer confidence. That's the point. And at the bottom of consumer confidence, when people are hiding under the table, screaming and crying, and they've been starving for the past 5 years, that's when you actually have the most insatiable appetite for consumer durable goods spending. So this is a classic contrary signal. The reality as an investor is you want to go very, very bullish on the markets at the lows, and you want to go a little more circumspect, shall we say, to be polite, at the highs. And the same thing with the unemployment rate. You think, well, the unemployment rate is down to 4%, and in Canada down to, say, 6%. Although, interestingly, today, Stephen Poloz had indicated that there's more slack in the labor market than meets the eye. I'm looking at the U.S. here, because we all know that whatever happens in the U.S. comes back to Canada with a bite, one way or the other. And you can see that when you get to the trough unemployment rate in the United States, always happens just before the recession. What's happening in the United States, simply put, is that after 105 months of expansion, we're starting to run out of employable workers. So we have another contrary indicator. Look at the peak in unemployment. Peak in unemployment is when you want to start getting more bullish on the expansion, and you want to start getting more bullish on the market. That's when there is a big runway for growth. You have a very long runway for growth at those peaks, and a very short runway at the lows. Once again, a terrific and reliable contrary indicator. The same thing with what economists call the output gap, which measures the degree of excess capacity in the economy. When you're in excess supply below the zero line, you have disinflation pressure, interest rates are declining, and you typically get very good market performance. Excess demand, well, we just recently poked our nose above the zero line, and you can see once again, just like the unemployment rate, a different way of corroborating the evidence that we're heading into late cycle. We're past the peak of autos, we are past the peak of housing, and as I said before, we have the Federal Reserve to contend with. There's been 13 cycles in the post-World War II experience where the Fed raises interest rates. And you can see, if you're playing the probabilities, 10 of those 13 landed the economy in recession. That's unfortunate. In 3 periods, you got what the economists call a soft landing, where growth slows, and in fact, there's never been a cycle where you finish the Fed tightening cycle with economic growth accelerating. It always decelerates. The soft landings are when the Fed just gets out of the game of raising interest rates in time. The economy slows down but does not go in a reverse. There's a very big difference between seeing a pay cut and just having your wage growth slow down. Think of it in those terms. The mid-60s, the mid-80s, and the mid-90s, the mid-90s being that period when Alan Greenspan pulled off the soft landing and people started calling him Maestro, and he started believing his own press, unfortunately. You could see 10 recessions, 3 soft landings, but there's no get-out-of-jail-free card. Either way, the economy in the next, say, 12 to 24 months is going to be slowing down. If you are in economic-sensitive sectors of the economy, like travel and tourism, or, say, construction, or durable goods manufacturing, it's going to be pretty tough. I imagine in the dental business, you still have to go see your dentist no matter what. That, to me, is more of a necessity. But for your clients that are in cyclical industries, I think they'll be going more for the necessary work on their molars as opposed to anything that's cosmetic in nature. So what we did in-house was we took 15 indicators that we can take going back to decades, macro market indicators. We looked at how they are performing this cycle against how they normally perform in other cycles to sort of get a gauge as to where we are in the cycle. And looking at the whole amalgam and looking at the average performance, it's telling us that we're 89% of the way in this economic cycle. There's a lot of people that would want to know where are we in this cycle, not just investors, but business people that want to know how to manage their inventories, how to manage their hiring intentions, how to manage their balance sheet. Everybody pretty well who's connected to industry or the markets would like to know where are we in the cycle. And when I say that we're in the 8th inning, it's basically just doing the math of what does 90% through a 9-inning baseball game really mean, and it means that we are in the 8th inning. So here's where we are, and there's early cycle investing, mid-cycle investing, and then there's investing around the late economic cycle. We start raising some cash, which we've done already. We're emphasizing our credit hedge funds, which are long-short strategies in the fixed income market, which have no correlation to interest rates, no correlation to the stock market, and actually benefit immensely from heightened market volatility. Focus on low beta stocks, which means less risky stocks. Focusing on companies that have earnings visibility, not variability. We want to own companies that have very strong balance sheets. And we also want to have inflation protection in our portfolios, and I say that because I'm not a long-term inflationist. I think that the secular forces of excessive debt, aging demographics, technology, as the latte liberals in Davos have called this the 4th Industrial Revolution, but whether it's about robotics or AI, the shared economy, and I'm sure that you've seen it in your own businesses as to how technology has been wonderful in cutting costs. But we are seeing classic late cycle inflation pressures emerging. Nothing dramatic, but enough that will take interest rates moderately higher, not substantially higher, but moderately higher over the course of the next 6 to 12 months, and we want to be protected for it. So this is really the antithesis of the early cycle investing that you see on the left, where you can be long high yield, you can be long high beta, high cyclical stocks, you can be long the economic sensitives in emerging markets. And what we've done is we've been investing across this whole continuum. That's what's interesting about this whole cycle chart I have here, is that across this whole continuum of the cycle, there's an appropriate asset mix, an appropriate sector representation to be involved in. And so right now we are investing late cycle. I think if I ever do this call again in 12 or 24 months, maybe we'll be back to the early cycle with different valuations. of course, at a different market level. But the cycle is a cycle, and you cannot fight or ignore the cycle. You have to invest being in sync with the cycle. And so this is exactly what we're doing right now. We've tucked in our risk for our clients. As Josh had mentioned, we're doing this for ourselves too. We're the firm's biggest clients, or the employees of our firm. So this is how we're investing right now, cautiously and prudently. There will be another time to really start swinging for the fences, and that will be at the beginning of the next cycle. But right now, our game is to hit singles or walk on base, and deal with what the markets have delivered us, and understand that we are in a late cycle game and investing appropriately. So basically, preparing for the end of the bull market means that you want to be diversified. You want to be cautious about the degree of equity exposure you want to have. As I said before, one of the unique characteristics of our firm are our credit hedge funds, and they generate a nice economic rent for our clients without capital risk that you get in the equity market. So investing in boring companies or investing in non-traditional fixed income investments that are not correlated with the stock market or interest rates was 100% appropriate for where we are today. So look, a lot of people don't like the late investing story, the late cycle story in North America. Of course, that pertains to Canada as well. But like I say, there's a big world out there. And so the way I look at the United States in particular, and Canada I don't have on this chart, but that's right up there with the U.S., and I take a look at a whole different series of valuation metrics. I look at price to sales, I look at price to earnings, I look at EV/EBITDA, and I look at price to book. I look at a whole range of valuation metrics, and the 94 on the U.S. means this. It means that 94% of the time in the past, the U.S. stock market was trading cheaper than it is right now. In other words, only 6% of the time in the past has the U.S. stock market been as expensive as it is today. And our recommendation is not to buy high and sell low. We want to buy low and sell high. So what we've been doing over time is gravitating out of the U.S. to other parts of the world. We have liked Europe, we still do, but I highlight Japan in there because it's very interesting, especially if you want to invest in a cheap stock market that is more mid-cycle. Japan really stands out. And of course, people in Canada think that, well, I want to invest in the Royal Bank, or I want to invest in Manulife, I want to invest in Enbridge, and I want to invest in CNQ, and we know and we love all these Canadian companies. Of course, Canada has not been that great a stock market in the past little while, but we always try and educate our clients that Canada is 2.5% of the global stock market. It is 2.5% share of the global economy. The U.S. is another 30-35%, but look, folks, there is another 60% of the world out there, another, call it, $60 trillion worth of equity capitalization in the public markets. And Japan has 4 times the market cap that Canada does, and is liquid and looks very good to us. The 48 number above Japan means that 52% of the time in the past, the Japanese stock market has been more expensive than it is today. Japan is actually one of the few markets in the world that is actually very attractively priced. We could point to the UK, but you have Brexit risk there. You could point to Korea or Hong Kong, but emerging markets in the late stages of the cycle tend to suffer from liquidity problems. Those markets are cheap as well. But Japan is liquid. Japan does have a very strong political leader in Abe, and it's trading inexpensively. And when I look at the world output gaps, if you remember I showed you the output gap chart before of the percent of the economy or the extent to which an economy is in the inflation zone, excess demand, which means higher interest rates and less liquidity, the U.S. is the only country that's there. So that's a different way of looking at late cycle. When you're excess demand, you are late cycle. You're getting the inflation, you're getting the central bank into action, and you're much closer to the end of the cycle. And you can see that when you're below the zero line, you have a lot more runway for growth before inflation becomes a problem. What that means is the central banks can remain your friend. And we all know from this cycle, whether you're looking at the Fed or the ECB or the Bank of England or Bank of Japan, central banks really matter in this game of investing in the markets. And you see Japan still has an output gap of 0.9%. So I want to highlight that. It's not the only country that does, but Japan is about the only country in the world that has compelling valuations that still is early enough in the cycle that we want to be there investing in this country. Japan was asleep for a long time. As I said before, it has a very dynamic leader that's getting stuff done, unlike we have here at home in Canada. And we have 11 quarters of positive GDP growth in Japan. That's significant for a country that's been in and out of recession for so long. And the battle against deflation is over. We're starting to see some very modest inflation pressures, not crazy enough to get the Bank of Japan worried, but they are also out of deflation, which is great news for corporate profits. Their leading economic indicators are still pointing north. You cannot say this right now about Canada, by the way. And profit margins at all-time highs. There's been a breakout in corporate profit margins, and ultimately, this is what you're paying for as an investor. You're paying for corporate earnings. So it's interesting to me that profit margins are at all-time high, but the Japanese stock market, as you can see, is one of the only stock markets in the world that's still 40% below its previous all-time peaks. But Abe got elected for his third term in October with a resounding majority. It was at that time, in case you don't think politics matter, that the Japanese stock market started to break out, and I would say that this is one of the few markets in the world that isn't just in a cyclical bull market, but a secular long-term bull market. A little math here, in case you believe in mean reversion. I certainly do. When people ask me, how did I call the housing crisis when I was at Merrill in the last cycle, how did I call the housing crisis so aptly, wasn't rocket science. I just looked at the charts. I believe in mean reversion. I looked at home price to rent ratios. I looked at housing to GDP ratios. I looked at mortgage to debt ratios, and I could see that, we were basically in, when you're 1 or 2 standard deviations above historical norms, you're in trouble. Well, this is the opposite. This is looking at the Japanese stock market cap as a share of the total global market cap. And you can see for yourself that we were well below the 8.5% average. If this chart were to mean revert, this would add 25% on its own to the Japanese market valuation. So on top of this, the valuation, on top of the fundamentals in Japan, which are positive right now, the foreign investor has not really participated in this market just yet. Japan is still climbing back from years of being in the penalty box. But if we mean revert this chart, this is going to add a lot of incremental valuation growth for our clients in this particular market that we happen to know every bit as well as Canada or the United States. I published late last year top 15 reasons why investors should love Japan in the National Post. I have this actually as part of the daily that I do, which I hope that you sign on for, and it's actually proven to have been a very profitable trade for our clients. So it's all about late cycle in North America, how to invest around it. One of the ways you can get around late cycle investing in the equity market is to start thinking in Japanese. And on that note, I'll say domo arigato and hand it over to Josh.
Thank you very much, David. We always appreciate your valuable insights. And as a thank you for attending the webinar today, we'd be pleased to offer you a complimentary 1-month trial subscription to David's daily research report, Breakfast with Dave. Again, please reach out to me directly if you're interested in taking us up on this offer. Of course, as well, if anyone listening today wants to discuss their own investment situation in more detail, we'd be more than happy to do that on a complimentary basis, of course. So thank you again so much for participating and having us, and to Eric and Cirrus for co-hosting today.
Excellent. Thanks so much, Josh, and thank you so much, David, for that. Certainly very insightful in terms of the current economy and how we should make sure that all our portfolios are adjusted specifically for it. While we had David on the line, I also wanted to make sure we extended into any question and answers, as well as some additional information that you may find helpful, which should be on your screen now. Feel free to pose any additional questions, let it be about the economy, let it be about their specific portfolio, or how, for example, Gluskin has specific funds as well as investment strategies that are not available through your current broker, investor, or investment manager solution. So feel free to post any questions now. If there are no questions, feel free to move forward with our upcoming poll, where you can easily, with one click, request a Cirrus Lease complimentary consultation, as mentioned before, or definitely reach out regarding the Gluskin Sheff complimentary daily emails from Dave. And as they start to pile in, you can also note what time is best to attend any future webinars, as well as anything specifically that might be important. And you can request both a complimentary lease consultation as well as a investment review and free trial subscription of David's daily research report. On that note, we'll leave that open for the next few minutes to make sure everyone has a chance to click one or all. And looks like we have some interest in terms of those looking to build out a practice into the future, as well as those looking to retire or relocate. Those are certainly some critical times to make sure that not only is your personal investment strategy aligned, but also specifically designing your contractual commitments to your landlord, also most important as well. So I'll leave that open for the next few minutes. On this note, I just really wanted to extend a huge thank you for Josh for joining us today and helping to be a key partner as we move forward and help to better serve our thousands and tens of thousands of clients, as well as especially David Rosenberg. I've had the privilege of attending some of his seminars and speeches and engagements and networking opportunities right at Gluskin Sheff's headquarters. If you have the opportunity to do so, I would strongly recommend it. Certainly it's a perfect opportunity to bend his ear on how specifically to your practice or to your eventual retirement, any specific advice on how he can help, and certainly a great institution that can help to make sure that you have a key long-term strategy for protection and wealth creation and growth. So on that note, let me add some great thanks, and we'll keep the polls open for a few more minutes so everybody can log in a vote. And thank you again for your time, everybody, and have a fantastic day.